Derek, you're good to go.
Awesome. Thank you, Summer. Welcome back, everyone. Glad to quote unquote see you all in the chat panel again, and looking forward to a good conversation tonight about one of my favorite topics, and it's looking forward to the future, right? We've been talking about cash management, providing for today. We've been talking about protecting yourself against financial catastrophe with insurance. And now we're going to turn our attention to looking ahead. We're going to talk about investment basics over the next 90 minutes together. We're going to really just do a nice overall intro to investing, talking about kind of how investing works, why it works, how it's attached to the business cycle, what is a fiduciary standard, how to find a financial advisor or planner. Some of you on the line might be financial advisors or planners or former financial advisors like myself. And so you might have some great industry insight on that for folks as you help them along. Talk a little bit about robo-advisors and some more modern investing techniques, maybe a little bit about fintech and that sort of thing. And then we'll talk about time value of money, everyone's favorite, right? So everyone's favorite math formulas, time value of money. But really, we won't go deep into math here tonight. We're just going to talk about the concept. We're going to talk about inflation, interest, compounding, and then some risk mitigation when it comes to investing. And then we'll turn our attention after that to the types of investments that you can purchase: stocks, bonds, mutual funds, that sort of fun stuff.
Hey, Derek, can I just say one thing really quickly? Because a
Yes.
lot of people ask this about
Yep.
math on the exam, and I don't know the details. I couldn't tell you if I did, but you're only allowed a four-function calculator. That means you can add, subtract, multiply, or divide. So if you can't do that in the math you're studying, that probably is not on the exam.
Yeah, that's a very good tip, right? We're not going to necessarily be solving for like for number of periods in a time value of money calculation. We're not going to be solving probably for present value of annuity, although it's a really good thing to know how to do, right, as a financial counselor. So, you know, it's one thing to study for the exam. It's another thing if you're interested in time value of money formulas. I'll give you a couple tips as we go on, as far as using Excel maybe here and there, just to give you an idea. So let's start with the business cycle. So why do we start with the business cycle when we're talking about investing? Anybody have a good guess? Put it in the chat panel if you would. Why are we talking about the business cycle when we're talking about investing? Okay. Why would we care about the business cycle in the economy when we're talking about investing? Yeah, so the business cycle impacts everyone, including businesses, which is a big deal when it comes to investing, right? Because when we talk about investing, what is the primary thing that we're investing in as retail investors? And it's not a trick question. How about this? It's right here in the title. Businesses. Yes, thank you, Marguerite. Thank you. We're investing in the stocks of companies. We're investing in businesses. That's why we care about the business cycle, right? And so just be aware of this. Now, the business cycle obviously meaning, you know, this can ebb and flow, and it depends on the type of sector, the type of industry within a sector that a business is in, how the business cycle will impact their specific, the value of their specific stocks. But just note, for overall macroeconomic type of concept, that the business cycle does look like anything else. There's an expansion period, and then there's a peak, and there's a contraction down, and then there's a recession, this kind of valley, and then there's a recovery, okay? As I just so expertly drew on the slide. So you want to just know, where is the peak, right, up here? Where is the trough? Down here, right? What is it called when it's on the upswing? It's called that expansion. What is it called when it's on the downswing? Contraction. What is it called for prolonged periods of time in a trough? Okay, when I say prolonged, usually we mean longer than 2 business quarters of sustained GDP loss, and that would be a recession, right? Our last big recession was as a result of the coronavirus pandemic, okay, when the market went down significantly last spring, about a year ago. It went into a period of recession, a pretty deep cut recession. A lot of folks didn't necessarily know that because, yes, we had high levels of unemployment. We continue to have higher levels of unemployment, but a lot of folks didn't know we were actually in an honest to goodness recession because at some point the stock market became unhinged from the realities of the pandemic, and it started to rebound despite the fact that we were in a recession and record unemployment persisted. On the way up, this is obviously the recovery. So you want to just be aware of the general business cycle and what it means in a macroeconomic sense, but also understand that when the economy is doing, when I say that the broad economy is going through this business cycle, individual stocks are going to react differently to what's going on, right? So when you have a period of contraction and you have a trough in a recession, then certain companies are going to be underperforming, right? They're going to be really hurt by that type of macroeconomic activity, like consumer discretionary companies. Places where folks really maybe clothing stores, maybe accessory stores, handbags, these types of things, where people are saying, you know what, it's a recession, we're in a trough, I'm going to save money, I'm not going to go spend on discretionary items. Those will be stocks that will kind of ride this business cycle, and you'll see them act the same way as the business cycle. There's other stocks that are called defensive stocks, and those stocks will actually still probably perform just as well in a trough as they would at a peak, because people are going to use these companies no matter what. And these are things like cell phone providers. These are things like Procter and Gamble or Johnson and Johnson, because you're going to hopefully brush your teeth and use underarm deodorant, even if we're in a recession. So there's certain companies that are defensive and there's certain companies that are cyclical. The business cycle relates to all of them. It just depends on what type of products, services, or whatever they offer in terms of how they're actually going to behave in this type of environment. So just be aware of the terms associated with the business cycle, and you'll be in good shape there. True or false? The safest place for money is under the mattress. AS says false. Most of us say false. Okay, so if that's true, which it is false that the safest place. I don't know. So why is that false? Why is it false for the safest place for money to be under the mattress? In my house, it would probably be because my kids would probably figure out it was under the mattress and they would take it, right? But in terms of what we're talking about with our finances, yeah, I mean, inflation. And we're not keeping up with inflation if you stuff under the mattress. Unfortunately, we're not even keeping up with inflation if you put it in a savings account right now. And we're not keeping up with inflation if you put it in even a moderate term CD. So people are really having to turn to stocks to try to at least keep up with inflation, because the yields on bonds are also at historic lows. So people have been turning to stocks. They've been turning to those riskier types of investments to try to make up for the fact that they cannot get decent returns out of bonds or savings vehicles at the bank to keep up with them, even keep up with inflation, let alone grow their retirement nest egg to a point where they need it. So vocabulary, fiduciary standard. What is, I mean, a couple of years ago, this was everything that was, every headline, every financial headline had to do with the Department of Labor Fiduciary Act that was being discussed. And it was a big deal. And people that were in the industry were up in arms about it. People that were financial advisors were up in arms about it. Whereas others, like financial regulators, were saying, well, why in the world, why wouldn't you want to be a fiduciary for your clients? So what is a fiduciary? Fabian says, it's somebody that has to have the best interest of the investor and not of themselves when they manage your money. That's absolutely correct. By legal requirement, the fiduciary standard is a requirement that an agent will put their client's interest before their own. Usually, what does this mean? It means when they're making recommendations. So let's talk about it in a practical sense. It means when they're making recommendations, it used to be, and it still is in a lot of cases, that they would be fine if they were making recommendations that were suitable. Okay, recommendations, and those could vary in cost to the investor. So as long as it was suitable based on the investor's situation, they were legally okay. Well, a fiduciary standard would say, actually, you have to be a little bit more specific than that. And they really care a lot more about the cost. So they're going to say, you have to make a recommendation that's in their best interest cost-wise. And if for some reason they don't choose that solution, you have to show in writing that they've made that recommendation, and they have to sign off that they're going to do something else anyway besides the recommendation you gave them. So the fiduciary standard is just another kind of safeguard for investors. So it used to be everyone was talking about how every account was going to have, you're going to have a fiduciary standard as an advisor. That never actually went all the way through. However, on most retirement accounts, in tax advantaged accounts like IRAs, and especially like employer sponsored accounts, there's a fiduciary standard in that the managers or administrators of that account have to treat the money. They have to put your interest ahead of their own. If you have a regular brokerage account, either single or joint, it may or may not be, your advisor may or may not be held to a fiduciary standard on that account specifically, which is kind of it's a little slippery. It's a little tricky, right? Some advisors have to be have a fiduciary standard on the retirement accounts that they manage, but not on the brokerage accounts. Whereas other advisors will just say that, hey, no, we're just a fiduciary on everything because that's the way we want to run our business. So the best rule for somebody looking to invest is to ask the person that they're looking to hire to help them manage their money, whether or not they're a fiduciary, and on what counts they're a fiduciary for. And if they say all accounts, I'm a fiduciary, great. And you want to ask how they get paid, because that'll be another key indicator. And we'll talk more about that in just a minute. So I just answered this, sorry. All financial advisors are required to maintain a fiduciary standard. That is false. And Aya says, why would anyone want an advisor that doesn't have a fiduciary standard? And the answer is, a lot of people just don't know that it's a thing. They don't know that they would, I think most people would assume that everybody would be a fiduciary, and that's how they would act, that they would put your best interest before theirs. So there's just that sort of lack of education around it. And so the more people know about it, obviously the more they say, well, I'm going to have a fiduciary because that makes more sense to me. Here, the thing about fiduciaries, if you go with somebody that's a pure fiduciary, maybe they're a certified financial planner, fiduciary, and maybe for some reason the cost is greater because they're providing more depth of service or whatever than somebody who is just a financial advisor, stockbroker. So, there might be a cost element there, depth of service difference type of thing, but in a lot of cases, I think it's just a lack of education, a lack of information. Okay. So is there something special you have to do to be a fiduciary? No, Marion, you just have to work for a firm that has that structure, and that's the legal kind of structure of the firm and how they set it up. So in the firm that I used to work for, people are fiduciaries on retirement accounts, but not on brokerage accounts. And so they have the cover of the brokerage firm on those accounts that they're not fiduciaries for. So if you had your own independent firm and you weren't a fiduciary on brokerage accounts, you probably would have some liability insurance considerations that you'd have to invest in and stuff above and beyond if you're a fiduciary or not. So there's those types of things, but there's not some special. There is a credential out there that you can get. I think it's called an AIF. It's asset or an investment, or it's an accredited investment fiduciary. That's what it is, and it just tells that you kind of studied for it. You know what a fiduciary does and how they should act, and you took a test and passed it. So there is a credential out there for it, but most of the time it just depends on who you work for and how they've structured their business. Who regulates investments? What organizations? You got it. Tom and Lisa nailed it right there, right? And the state, and yep. US is the Securities and Exchange Commission, the Financial Industry Regulatory Authority, and state regulatory agencies all can regulate investments. Okay. There are certain types of investments out there that are not regulated. Can anybody give me an example of an investment that's not regulated? I'll give you a hint. It's something that you read a lot about, but most retail investors don't actually invest in it because it's very high risk. And yeah. Crypto is unregulated to date because there's just no kind of structure around it altogether, right? Real estate is more or less regulated by tax codes and that sort of thing. What I'm thinking of is hedge funds, and I'm thinking specifically of you know, SEC, FINRA. They regulate, you know, equities, debt, securities. Those are your bonds. They also regulate mutual fund companies, but hedge funds are, you know, private types of mutual funds that can kind of do whatever they want, right? They can borrow to invest, they can invest with debt, they can leverage, they can use options, commodities, et cetera, to do what they're doing. So hedge funds are largely unregulated, which increases their risk. What would you recommend to a client seeking a financial advisor? We talked a little bit about this already. State regs and FINRA. What would you recommend to somebody? They say, hey, you have a financial counseling client. Summary, hey, seek a fiduciary. That would be a good start, right? Yeah, you know, that fiduciary, you are the role of a financial counselor, the role of an AFC when it comes to investing is primarily one of education, right? So this is a perfect opportunity for you to educate your clients on what it is to seek out a financial advisor. Okay, so when I tell people about to, you know, that are asking, what am I looking for in a financial advisor, I always talk to them about the 4 C's. Okay, and that would be character, cost, credential, and credibility. Credibility, I think I spelled that right. And I just came up with these because these are things that when I was an advisor, I would, you know, look for in my advisors around me to try to emulate. And people would always ask me questions to this extent, you know, character, do you like them? It doesn't matter how much they cost or anything else, but if you really don't like working with them, then you're probably going to look for somebody else, right? Because they're going to help you manage your money and your most important financial decisions. Cost, how do they get paid? So somebody in the chat panel said, seek a fee-only advisor. Well, maybe, but if you have a portfolio that's kind of passive and you just kind of let it ride and you really don't want them to do much with it, maybe you're going to trade once or twice a year or whatever, and you're not going to add anything to it. Maybe a fee-only advisor is going to be more than you want to pay. So you have to think about, how do you want to invest? Okay, and how do they get paid? And fee-only is definitely attractive, and that's usually what that means is they would get paid 1 or 2% of assets under management per year with a fee-only structure versus a commission, right, structure. But again, it comes down to frequency of your frequency and cost of your transactions, right? If you're not really trading much in single stocks, then and you're not really adding money to your portfolio, then a fee only might be too expensive. Otherwise, if you are adding money every paycheck or every month, then a fee only can make sense. But it comes down to those two questions. Credential, this is going to be what are their credentials, right? You're getting an AFC credential, you're working towards that. The gold standard in the investing world is a CFP, right? The Certified Financial Planner credential. There's also AAMS, Accredited Asset Management Specialist. So these are credentials that tell you that that person studied for and took an exam. They know, they have a working baseline knowledge of what they're talking about. That doesn't mean anything except that they studied for, took a test, and they have experience hours. Now, some of these, like the CFP, have a considerable amount of experience hour requirements, which I think is so important because that's where it comes to the credibility. So you want to know, like, do they have experience working with somebody in your situation, and what did they do for that person? These are great questions to ask a financial advisor. So I would tell you all, steal this from me. Steal the 4 C's: character, cost, credential, and credibility, and use it in your counseling conversations. And if you have somebody who kind of checks every box, and you feel comfortable with that person, you like working with them, then by all means, hire them as your financial advisor or your financial planner. Otherwise, if you're not comfortable with how they get paid, they have good credential, credibility, and character, but they're just way too expensive, you might go with somebody else. So you want to look for somebody who is really kind of checking most of these boxes for your specific situation. Time horizon. When it comes to investing, time horizon, okay, is the time until the invested money needs to be liquidated. What does that mean? Oh, sorry, Melissa, I said that fast. AAMS is Accredited Asset Management Specialist. And that's just one example of the many credentials that are out there, right? Like I said, the CFP is the one that is grueling, very grueling to study for and to test for. I'm at the end right now of my CFP education core courses before I can sit for the exam. Got all the experience knocked out, but the courses themselves are like, yeah, they're pretty grueling. And if we have any CFPs on the line right now, you know what I'm talking about. Time horizon is the time until invested money needs to be liquidated. When it comes to investing, what does liquidated mean? What does it mean when you liquidate an investment? Sold, right? Pretty much you're selling it, right? You're cashing out, you're selling it. That's right. So time horizon tells you how long until your invested money needs to be sold. Okay. So what do you think is a good threshold for time horizon? What's the minimum time horizon somebody should have to consider investing as an appropriate option? Shane says 5 years. I love Artie's answer. Depends, right? Maybe a business cycle, maybe, I don't know. But usually for me, when I'm talking to folks, it definitely depends, but generally 7 to 10 years. If you're investing for anything less than that, then you're going to face what's called increased volatility. If you look in the history of the stock market at different 1 year, 5 year, and 10-year periods, and you just look at those rolling periods, you're going to have a higher probability that if you only have your money invested for 1 year, you're going to have a very high probability that when you need it in a year, that your balance will have gone down. Okay, you're going to have a high probability of that. Usually it's 1 in 4 years. And this is just historic, right? One of the things you do when you counsel about investing and educate folks is you tell them past returns do not guarantee future results. Just get used to saying that. But when you're looking at the history, about every 1 in 4 years is a negative year in the market. So this wouldn't be a good thing if you invested in the year that you need it was down. So then you go to 5-year rolling periods, and the probability of it being down when you need it is less, but it's still relatively high. It's a high risk that it may be down further than you'd like when you need to pull it out in 5 years. It's only when you get up to the 10-year rolling periods that you start to get a really nice probability that you're going to have made money. So that's what we're talking about, okay? Is that you want to kind of leave it invested for 10 years, and so then you think about your goals, right? Your investing goals. So what are the most common investing goals in the chat panel? What are the common investing goals? Yeah, retirement is the most common. So that's usually a longer time horizon, right? What else? Yeah, already education. It's usually a mid to long time horizon for folks. Buying a house, it could be. And so this is it. When you start to get into these two, where it's like house or maybe starting a business, you really want to be careful, because if it's a midterm goal, this is where people start to say, well, I want to invest for that. And so this is where, as a counselor, you might want to talk to them about the history of rolling returns, and just say, well, if you're going to buy that house in 7 to 10 years, you could consider doing it. But if it's shorter than that, you might want to try another approach. That's all. Time value of money. Here we go. This is probably the most important concept in finance. Certainly in personal finance, it's something that people really want to just know the concept. But if you're like in finance for business, it's the most important concept. And so you really want to kind of understand these concepts of inflation, interest and returns, and compounding. So inflation, this is the way that prices tend to increase over time. We talked about that before. It causes your purchasing power to go down by the actual rate of inflation. What did we say the average rate of inflation was? Does anybody remember that from a previous session? Average rate of inflation. Yeah, it could be around 3%. I usually say 2 to 4% myself when I'm doing like projections for folks, but 3% would be fine to project. Okay. Interest and returns. This is the money that's invested with intention of gaining profit. The goal is that the profit is greater than inflation, because you want to at least keep up with inflation, but then you want to beat it, right? And so when we're investing, that's what we're trying to do, presumably, right? Is maybe at least to keep pace with inflation. If your primary goal is capital preservation, you just want to keep your money intact and you want to maintain purchasing power, then you want to at least make that 3 to 4, 5% a year on your money. So if that's your primary goal, you may choose investments that are not as risky, but won't return, the 8, 9, 10% over time average. If your goal is profit and you want to just get as much as you can over a longer period, then you may choose the higher risk, higher return type of portfolio that just has a higher percentage in stocks. Okay. So it's goal driven, right? Interest, returns, and investment selection. Compounding, we know this concept, right? We're in this session, we're in this course, we've talked about compounding interest before. It's where you earn interest on interest. And this is that snowballing impact that that we need to know about. It's very important with, savings and savings accounts. That is compound interest. Compound growth in investing is a little different, right? Because think about it. When you put your money in a savings account, it might be earning what? 1%? Okay. So in a good savings account, it's earning 1% right now. Okay. So let's just be a little bit more rosy and say you put it in a savings account at 5%. So then you know that if you leave it in 1 year, you're going to have $105 in that account, aren't you? Right? After year 1. That's very, very rosy, I know, but it's better. It's just better. It's easier for my math. Okay. So after 1 year, you're going to have $105. Year 2, you're going to earn another 5% on the entire on the 105, right? So that's how that works. And it's going to do that on and on and on and on and on every year, 5%. The 5% is going to be locked in if you're in an account that does that. Okay, that's a savings kind of structure. With investing, it doesn't work that way, does it? Investing, the returns are different every year. You don't have 5% every single year in investing. Some years you have 5%, some years you have 10, some years you have minus 10, some years you have plus 20, some years you have minus 30, and that's the way it goes. So when we talk about compounding in investing, we're talking about compounding growth, not really compounding interest, okay? Because if you think about the way that investments work, you leave them in there. You get dividends from your stocks and interest from your bonds throughout the year. And if you have those set to automatically reinvest, that's going to add into your balance. And then every day that it's in the market, okay, it's going to be compounding. Your entire invested balance will either be growing or it'll be going down. And what we're talking about when we talk about market returns over time is the average growth per year. So just understand the difference between when we talk about compounding interest in savings accounts and compounding growth in investing. When we're talking about compound growth in investing, there is no guaranteed 10% per year in investing. There is no guarantees, period. It's not like investing is an insurance product where you can have a guaranteed index inside the insurance product. No, it just goes up and down. So when I say 7%, it means that was the average over the long term. And I guess that's what I'll say right now. If you look at the history of the S&P 500, which is an index of the 500 largest companies traded in America, the average return is a little less than 10% over the last 50 years. However, if you subtract inflation, the real return would be around 7%. So when I run calculations for investment projections, I usually use 7% just because of that, for that reason. Yeah, Marguerite, if I had a bank that was paying 5% on savings accounts, I'd be putting a lot of money into those accounts. Yeah, I'd still having money invested into the S&P 500 for a little bit more, but a lot of for the money I want in the next 10 to 20 years, I'd probably be putting them in those accounts. But we don't have those accounts, which is why so many people are investing in stocks, which is why it keeps going up and up and up and up and up. This is the danger of a very low interest rate economy, is that people have to go into stocks and go, buy. And so then every day that you read Yahoo Finance or whatever, people are saying, well, we're in this overly inflated stock market. And it's like, yeah, because where else are they going to put their money, right? So anyway, a little tangent there. Real world finances. Your client just won the lottery. Given the choice of $30 million now or $1 million per year for 30 years, which would you recommend? What do you think? Depends on the age. Real world finances, right? So it's like, is there a okay, so I see somebody saying 30 million now, I see somebody saying 1 million per year. What I'm interested is, how do you arrive at those answers? Why would you say that? Okay, so you might ask them some questions about their spending behavior. If that person's responsible enough, take the 30 million now and invest it, but if not, 1 million a year is safer. Maybe that's one reason that you would take the million. Compounding of the 30 million, and if invested, might be a consideration, right? Yeah. Depends on the parameters with taking the money too, and that might be like, how can you take it? Can you take it in a lump sum? And Lovinus comes in with one of the big considerations, which is taxes, right? Yeah, so it's winning 30 million in the lottery is definitely not 30 million. If it was 30 million in life insurance, it would be 30 million, right? That's very true. That's very true. Yeah. So, okay, so we have a lot of considerations here and some questions to ask. one of the things you can do, so my question to you all is there an objective answer to this? Is there a right or wrong answer? No, there's not. Let me ask you this. Is there a mathematical answer, right or wrong answer to this? Yeah, there is, right? Probably. I love it. Probably. And so the answer is that there is, right? There is a mathematical answer to this, right? So what you'd want to do this is you'd want to find the present value of an annuity. And this is something you want to know just as a financial counselor, is a stream of payments. When I say annuity, I don't mean the insurance contract annuity. I mean, well, and this is why it's called, the insurance contract is called an annuity, is because it's a stream of payments, okay? And in this case, you'd be having a stream of payments to yourself, okay? And what you'd want to do is you just run a present value time, and this is outside the scope of the exam probably, but this is one of those tips that I was telling you I'd share with you. Just run a present value, time value of money formula in Excel, and you would just input the variables, and you could just say the rate, you know, if you took the money and you invested it at 0.07 and the number of periods is 30 and the payment is $1 million. Okay, and I'm not going to actually go and do this right now, but this is just for you to go check out so that we don't miss slides for the test. If you input the variables into a present value formula in Excel, you can actually get the present value of an annuity. And if the present value of that annuity is less than 30 million, then you would just take the 30 million lump sum. Okay. You could do that, everything I just said, or you could just probably click on the link that Summer just put in the chat panel, right? So there you go. So there is an objective answer, okay, mathematically. However, what I really like about some of your questions is that you said you got to know yourself and you got to consider other things like taxes. All of these things are valid questions and valid considerations when it comes to this question. But when it comes mathematically, you do a present value of an annuity calculation to figure out if the present value of $1 million stream of payments to yourself over 30 years is greater than or equal to 30 million. If the present value of that stream is less than 30 million, you would take the lump sum. If it's greater than, then you would do the annuity from a pure mathematics standpoint. Anyways, let's talk about something that's kind of like a shortcut when it comes to time value of money. Rule of 72. The rule of 72 is simply this. If you wanted to just talk to your client generally about education, for educational purposes, about investing their money and how long it would take their money to double if they invested it, you could use the rule of 72. And what this is you would literally take the number 72 and divide it by the interest rate that they think they can receive on their investments, and it would tell them how long it would take for their money to double. Okay. And so let's do it. So let's just say that they think they're going to make what we think we're a reasonable projection is 7%. So what's 72 divided by 7? Well, it's a little over 10. So that means that if you invested $1,000 in the market and it made an average return of 7%, then it would take about 10 years to turn into $2,000. Now, if you had it in something more aggressive and it had an average return of 10%, it would take about 7 years. And so that's the way the rule 72 works, is you just need to know the projected interest rate and go from there. Oh, look at Summer actually went and ran the calculation on the calculator she put in. It's if you run those numbers, you end up with 90 million in 30 years. Interesting.
If you didn't take out the million, you end up with like 250 million in 30 years.
Well, there you go.
7% is a lot of interest.
Yeah, it is. It's great. Yeah, so Manuel says, how does the rule of 72 applies in real life? Isn't it an interest fact with no applicability? I'm not sure what you mean. It says here it's going to be a conversation around average returns, right? So you would just disclaim, you know that you might project that you're going to make an average of 7%. Just know that that's not 7% every single year over year.
I would also say this is a sort of thing where, oh, if you're just taking a walk and you're trying to do some numbers in your head, which I do probably more than I should. I mean, this is not going to give you an accurate number, but it gives you a
Right.
ballpark, which is sometimes just what you're shooting for.
Mm-hmm. And it's actually pretty close. If you actually run the formula for time value of money, you'd be surprised at how close it actually is. It's pretty interesting. All right. So let's just run it ourselves at 6%. And this is going to actually be real world. This would actually happen. If you had a 6% CD, you can't get one of those right now. Sorry, guys. If you had a 6% CD, yes, you're choosing the interest rate yourself. Like you have to project what you think you're going to make, Kara. That's right. At 6% interest, how long would it take for a CD to double in value? So go ahead and run that number. And we have Melissa and Marguerite coming in with 12 years. And Chantal, yep. So there you go. So you figure that, just run the rule of 72 divided by 12, and it's that. 12. Or 72 divided by 6, sorry, and it's 12. So very good. That's probably one you could do with a 4-function calculator, right? Hint, hint. No, I don't really know, but I would just imagine you could do that with a 4-function calculator. When it comes to investing, risk tolerance, this is a big one, right? This is another key concept. This is an investor's level of comfort with risk. When we're talking about investing, it's not necessarily the risk that you're going to lose all your money. It's more just the risk. When we talk about risk in investing, we're talking about volatility, which is this up and down kind of thing that stocks and different investments can do over time. That is volatility. And that's what we're talking about. What is your appetite? What is your ability to stay put if your investment goes down? Do you have a high risk tolerance? Would you stay put and add more money, or would you sell immediately? If you sold everything immediately when everything went down, well, that would indicate you have a very low risk tolerance. So that's what they're talking about here. And I just kind of answered this, right? Investing in the stock market is no different than gambling. That's false. Because the stock market, if you invest in things like stocks that trade on the New York Stock Exchange or the NASDAQ, which are the two of the largest stock exchanges in the world, then these are not companies that are going to go bankrupt overnight, right? These are companies that have been around for a long time. Now they'll go in and out of favor. They might be added to indexes, taken off of indexes, but these are not the penny stocks you see in the Wolf of Wall Street. Okay, so is there up and down? Is there a risk involved in investing? Yes, there is. Is it the same as gambling where you could lose all of your money in one trade? Probably not. Okay, if you put all your money in a single stock and it's in an aggressive type of investment, you might lose a lot of it quickly. I mean, look at what just happened with like Tesla recently, and that's a big company, right? GameStop has had a lot of volatility, right? It's one where the Reddit crew, they went in and they just pumped it all up, and they did the gamma squeeze on all the hedge fund managers, and then all of a sudden they were like, "Oh, this is great, let's sell," and then everyone that did it started to sell, and they were taking their money off the table, and it flew back down. Then it doubled in price again 2-3 days ago. And then then it stopped exchanging. They stopped trading it so that people couldn't do that anymore. So that's a lot of volatility on one company in a shorter period of time. But even in that situation, people didn't lose all their money when everybody sold. They just lost a lot of it, and then it popped back up. So it's a little different than gambling. It's really different than gambling. There are risks though when it comes to investing, so you want to be aware of some of them. Volatility risk is what I just mentioned, the probability that a stock's going to fluctuate from a standard deviation, and how frequently it's going to do that. That's its volatility. There are higher volatility stocks, there are lower volatility stocks, and there are higher volatility investments like single stocks versus lower volatility investments like single bonds that just fluctuate in value less. There's business risk. That's obviously how a company runs its operations and the types of business it is and how it's exposed to different kind of political events, that sort of thing. There's credit default. And by the way, that's also the amount of debt that a business has. The higher the debt, the more business risk. There's credit default risk, and this is particularly true with bonds, where with a bond, you lend your money to an entity, a corporation, a government, a municipality, and you are banking that after a set period of time, they're going to pay you back in full. That's the way it works. You get to be the bank, right? So they get credit ratings to these things. And those credit ratings for bonds can be anywhere from AAA all the way down to junk bonds, right? Anything below triple B, right? So they get credit ratings on bonds. There's default risks with bonds. What does it mean? It means that, if they're lower rated, it means that they may actually go bankrupt. They may not be able to pay you back in full when your bond matures. And so that's the risk associated with bonds. Interest rate risk is also more associated with bonds. When you buy a bond, you lend money to somebody, like $1,000 bond, to a corporation like AT&T, and they agree to pay you 5% interest. And if you hold it for 10 years, you get back the $1,000. Okay. And that's how it works. But in the meantime, every year they're going to pay you 5% interest. So that's the way a bond works generally. So interest rate risk, it means that when new AT&T bonds come onto the market and they are trading and they offer 5.5% interest, well, if you don't want to hold the bond that you have, your 5% bond, if you don't want to hold that for 10 years and you want to try to sell it in the open market, do you think someone's going to pay you the full $1,000 for it when they could turn around and buy a $1,000 bond for 5.5%? The answer is no. They wouldn't do that, right? They'd want to give you $900 for your $1,000 bond, because why would they pay you the full value when there's new bonds on the market they could buy at higher interest? That's interest rate risk. Also, it might just mean that in 10 years, when you get your $1,000 back, interest rates might be lower. So you'd have to reinvest it at a lower rate. That's interest rate risk. Liquidity risk is what it sounds like. It's how liquid are your investments. Private placed investments like private mutual funds and private company investments are far less liquid than stocks you can buy on the New York Stock Exchange or through mutual funds. And inflation risk is what we talked about. Will your investment keep pace with inflation? Currency risk is when you're investing in foreign kind of securities, foreign stocks. And then you would need to think about currency exchange rates and those sorts of things. So vocabulary wise, portfolio, this is the collection of investments, plain and simple. Try not to use a lot of investment jargon if you're talking to somebody for the first time about investing. If you use the word portfolio, they might not know what that is. And that's really a turnoff. Like, it's hard for folks to kind of like learn when we're using words that they don't understand. So don't take for granted that people know, but it's a collection of investments. It's a collection of stocks and bonds and mutual funds. Diversification is another fancy word for spreading your money out, reducing investment risk by investing in a variety of different investments, right? And it's really important that we do that. Diversification is one of the greatest ways that we as individual investors have to protect ourselves from high volatility. If we can spread ourselves out amongst different types of stocks, different sectors, different industries, different geographic locations, then we're going to have greater diversity. And so if you you know, I always use the metaphor. What would you rather be if you're in a glass building and you're 100 stories up, okay, in a glass building, you can see out, and you're in an elevator. What would you rather be held by, 1 cable or 100? You probably want to be held by the elevator that was secured with 100 cables, right? Because then if 1 cable snaps, you're totally fine. You got 99 other cables, right? And that's the same deal with diversification. You want to just have your money spread out across all different types of investments, stocks and bonds. And then you want to have different types of stocks and different types of bonds. There's aggressive stocks, there's growth and income stocks, there's growth stocks, there's corporate bonds, there's municipal bonds, there's federal government bonds. And so you want to kind of own a little bit of everything. Thankfully, you don't have to go to a broker and try to build your own portfolio that way. You can do it via a mutual fund, which we'll talk about in just a minute. The other key concept is asset allocation, a defined portfolio of diverse asset types with a set percentage of each type. That's what I was just talking about. Mix it up. You want to go, the asset allocation, I think about A for asset allocation equals across asset classes, stocks and bonds. That's what asset allocation is. So when you do an asset allocation, you want to have a certain percentage of stocks. So if maybe you're younger, you might do 80% stocks, 20% bonds. That's your asset allocation. D for diversification, it means you're going to go deep in each asset class. So in your 80% stock portfolio, you're going to own stocks from different sectors and different sizes. Okay, you're going to own large cap, mid cap, small cap stocks. You're going to have tech stocks. You're going to have consumer staple, consumer discretionary. You're going to have it all mixed up inside, deep in there. And same thing with your bonds. Okay, you're going to mix up your bonds too. So that's the difference between asset allocation and diversification. You can just use the A and D trick that I just gave you to understand the difference. As you get older, by the way, a lot of people think you want to turn down your stocks, the stock percentage, and turn up your bond percentage as you age. And that might be true. It just depends on how much of your money you want to preserve, because bonds are less volatile than stocks. They're going to fluctuate in price less, right? But if you're starting a little late in the game, that might not be an option for you. You might need to be a little bit heavier in stocks. And just know that in the period of like the Great Recession, when the tide goes out, we see that everybody, we see that everyone was swimming naked. That's what they say. Nobody's safe in something like the Great Recession, where bonds went down, stocks went down, everything. But Albert says mature company dividend stocks can work as an alternative to bonds, and that's absolutely where most people have been investing their money. They look for really nice paying dividend stocks because they kind of act like bonds, right? There's those high dividend, big, large cap, blue chip companies that have been around for a long time. They don't necessarily fluctuate in value like Tesla or like even Amazon or Apple, and they're gonna pay a dividend. They're going to share profits with their shareholders, and they're going to kind of act like bonds in that way, but just maybe a little higher. And preferred stocks are another type of stocks that do act like bonds, Fabian. That's exactly right. Yep. Rebalancing is where you're going to just every year buy or sell stocks or bonds to bring your portfolio back to its designated asset allocation. So 80% stocks, 20% bonds. Maybe the stock market goes crazy, bonds don't do great one year, and now you're at the end of the year, your stocks have grown to 90% of your portfolio. So you'd want to sell 10% of your stock balance and buy it back in bonds. That's what it means to rebalance. Dollar cost averaging. This is the way most people invest their money, right? They invest the same amount of money at the same intervals into the same investment. This is how most people invest for retirement. And they usually do it through their 401k or 403b through work. And when you do that, the average cost of your shares is lower because you're buying more shares when the value of the shares go down than when the value of shares are up. Because remember, you're always putting in the same amount of money. So if you do $1,000, well, let's just say you do $500 a month. And month one, you're buying a mutual fund and the shares are, I don't know, $100 a share. So you get 5 shares. And in month two, they go down to $80 a share. You get, how much is that? $500. Oops, where's my thing? There it is. $500 worth of money divided by $80 a share is 6.25 shares. So the idea is when the value of the shares goes down, that's actually a good thing for you because you get more shares because you're still investing $500. And if you add up the amount of shares you have plus the amount that you actually invested, you'll find your average cost per share is lower. So that's the benefit of dollar cost averaging. Listen, a lot of folks don't really have a choice. This is how they can invest. So this is how most people invest. What are the 2 ways to profit in investing? We already talked about one. Growth in income. That's right. And Albert, you're right. You got to evaluate why the stock price went down before you buy more, except that when people are investing for retirement, like in a 401k, they're usually doing it in something like a target date fund or even an index fund or maybe some mutual funds that they're spread out across different types of stocks. And so they have this asset allocation that they've already arrived at in a way that they're comfortable with it. And so if it's just general market activity, it's not something you want to be readjusting your asset allocation month to month based on what the market's doing. So in your situation, sounds more like something like day trade, like you're going to buy single stocks. And you definitely, if you're trying to play that game of buying single stocks, you really need to know what you're doing. Most long-term retail individual investors that are investing for retirement don't buy single stocks. They buy mutual funds inside an employer-sponsored 401k. And they don't day trade, right? And yeah, so growth in income, right? That's it. That's all it is. Fabian nailed it, right? This is how you can benefit from investing. Capital gain, which is fancy for the value of the shares go up. That's what Kara said. That's a capital gain. And you get to lock that in if and when you sell it. But most people, again, are not going to sell the value of their shares every time they go up, right? That's not the way. That would be more like day trading. What we're talking about it's more like a buy and hold strategy. And then income from dividends is what we were talking about earlier. Companies share their profits with their shareholders through the form of dividends, and that's a percentage of the amount of that company that you hold. Okay, and it's a big deal. A portion of the company's profit paid to investors, usually represented as a percentage. True or false? Capital gains are taxed differently than other income. True. Well, it's true for long-term capital gains, right? You got it, Heather. I love it. So long-term capital gains is usually taxed around 10 to 15%, depending on your overall income. So it's more favorable than paying taxes at your normal tax rate. Short-term capital gains is when you get taxed at your ordinary tax rate. So the difference between long-term capital gains and short-term capital gains, you got it, Summer. Long-term means that you held the investment for a year and a day. Short-term is anything less than a year, okay? Let's talk about some investing fraud. Affinity fraud, there's a context clue in there. When I think of affinity fraud, I think about somebody going door to door and saying, hey, they come knock on your door and they say, hey, your neighbor just invested in this with me, so they told me to come over and talk to you because they thought you might want to be in on this opportunity. So why don't you go ahead and write me a check for $10,000 and I'll get you going. That's affinity fraud. They're going to leverage a personal connection. And unfortunately, it happens a lot. Ponzi scheme. This is the Bernie Madoff special, right? This is when Bernie Madoff was taking money consistently from new investors to pay old investors. And as long as new money was coming in the bottom of the pyramid, the people that had been investing with him for a long time could take money out, quote unquote, thinking that they were pulling from their investment accounts, when in reality he was just kind of cycling money from new investors to them, and then, you know, spending it on the rest of it and living on it himself. That's a Ponzi scheme, and that's obviously not a legal thing to do. What might you discuss with a client who does not want to consider investing because she thinks it is gambling? We kind of talked about the difference, so let's kind of drive that point home. What kind of questions would you ask that person that says, you know, I don't want to invest because it's too much like gambling? What would you ask them? Bring it back to the goals already, like asking what long-term goals they have might be a nice way to refocus and try, well, just to try to get you to help you understand why they think about the way that they do, right? And that might be a question for them, like what makes you, you know, what brings you to that conclusion? What's your experience been with investing, right? Those might be some nice questions to ask to see why they think of it as gambling. Gambling is a chance, investing is not. Yeah, I mean, it's just something that you might want to talk, you might want to pull out a chart and show them the history of the market returns and show them that whenever the market went down, it rebounded and kept going. And if you had stayed invested, you would have made money. Yeah. So those are some nice thoughts to think about, right? All right. Investing options. Obviously, you have cash equivalent investments, stocks, mutual funds, bonds, other investment options. We've been talking about these as we've been going, right? And I kind of told you the answer to this already, but true or false? An AFC qualifies you to give investment advice. Yeah, so this is this is what we're talking about. So false, right? It's the role of the AFC when working with clients on investments is one of education. I said that. So just remember that, right? You want to know the line. You can't give investment, tax, or legal advice, but you definitely can have some referral sources and some educational resources to when it comes to investing. And you might create your own decks. You might leverage some of the free publications from the SEC. SEC.gov has some great booklets. With the Saving and Investing booklet is one of my favorites. And then What's a Mutual Fund is a great booklet. So there's some fantastic resources out there for educating on investing. Okay. And then you have to ask yourself, how comfortable are you with investment options? You know, you want to know for yourself, am I comfortable? Could I sit down and explain to somebody the difference between the three types of investments: cash equivalents, debts, and equity? Could I sit down? Do I even know right now what those mean, right? What are cash equivalent types of investments? What are bonds, and what is equity? And the short answer there is stocks, right? So let's kind of dive into this for a little bit, and we'll peel this back. Cash and equivalents. These are things like savings accounts, certificates of deposit, money market accounts, and treasury bills. When it comes to types of investments, people don't think of savings accounts, CDs, and money market accounts as investments, but certainly treasury bills, they're technically a very low, they're a short-term bond from the federal government, right? The federal government issues bonds. Those are called treasuries securities. And that's when you lend money to the federal government, and they have different maturities for those bonds. And so a treasury bill is a federal government bond that is 1 year or less to maturity, right? A treasury note is anything that's 2 to 10 years in maturity, and a treasury bond is anything longer than that. So treasury bill is kind of considered cash because they can be very, very short term, and they're very, very low risk because they're backed by the federal government, which can make up money. No, just kidding, but pretty much, right? Treasury bills are considered cash equivalents. Money market, you want to know this, money market mutual funds. So there's money market deposit accounts, MMDAs, and there's money market mutual funds. MMDAs, money market deposit accounts, are savings account. They're institutional accounts at banks and credit unions. Money market mutual funds are mutual funds, and they are regulated differently than money market deposit accounts. And they're insured differently. Remember, investments are insured by the SIPC, whereas bank accounts like savings accounts, CDs, and money market accounts are insured by the FDIC. So those are cash equivalent types of investments that are a great part of your portfolio, especially if you have a goal coming up in the next five years that you're investing for, and you're looking, maybe we don't like to time the market, right? But if you put some cash in and you're just kind of putting it in over time, maybe you have some set aside in some cash equivalent investments ready to pounce if a correction hits or something like that. Okay. Bonds, we talked about, this is money loaned to a government or institution that is paid back with interest. Remember, with bonds, they are your chance to be the bank. You lend money to a company, a municipality. The New York City Water Authority issues bonds, for example, state bonds, federal bonds, government bonds, right? These are all types of bonds, and they, in every way, you're lending money and you get paid interest along the way. And then at the end, if you hold it to a maturity, you get paid back. Okay. So here's an example of an actual old paper bond. Most of the time you won't see these if you buy a bond through like a broker dealer. They'll hold the bond in-house for you, and they'll have that in inventory, so you won't actually ever get the paper, but this is what they used to look like. It's pretty cool. Who would like this? $100,000 treasury bill. That'd be pretty great. So debt securities is another name for bonds because you are lending to whoever you buy the bond from. Okay. U.S. government bonds have tax advantages. They're exempt from local and state income taxes. You still pay federal income tax on the interest, right? But not state and local. Municipal bonds are exempt from federal. And if you buy a municipal bond in the state that you live, it's also state tax exempt. So municipal bonds are awesome because you can get tax exempt interest from them. Corporate bonds are a little higher interest than municipal bonds because they're not backed by the ability to tax people. They're backed by their ability to earn profits. So they're a little riskier. So they have to pay a little higher interest. But this is corporations that want to borrow money to raise capital for projects and growth and all that sort of stuff. They issue bonds. On the other hand, we know that stocks, we already talked about, our ownership shares in a company, right? Ownership shares in a company. So true or false? When you buy stock in a company, you are buying a piece of the company. Is that true or false? Yeah, I see the trues coming in, and technically it's true, right? You are buying a piece of the company. What it really means is you have a claim on the company's profits, and or you'll be paid out if they go out of business, and you can have a vote for things like board members who pick the president of the company. So you actually have a say in stuff, right? So you're part owner of the company. Now, this doesn't mean that you can't walk into a meeting and take a chair from the conference room and say, this is mine because I'm part owner of the company. No, it's not how it works. There's a legal structure around stock ownership, but generally speaking, it means that you're part owner. And so you have a claim to some of the profits through dividends if they decide to do that. And you get to participate in the growth of the company, which is pretty awesome. And just it's true or false, stocks are also called equity securities. What do we think about that? Yeah, we talked about bonds are debt securities, stocks are equity securities, because you actually are owning something, with a stock. Okay, here's the magical mutual fund. Okay, so in your own words, in the chat panel, and get a little pop quiz, what is a mutual fund? Many of us own them, but not a lot of people can say what they are. And so this is something I want to challenge you all to be able to do, is to explain what is a mutual fund. A collection of stocks in one fund, is what Albert says. Heather, a collection of stocks, a cheap way to get diversification. I love that, Tom. And maybe cheap is subjective, right? So maybe it's an affordable way to get diversification. Michael says a basket of securities. Yeah, I like that kind of metaphor, right? Summer says it's a company that creates a portfolio of investment assets and then sells pieces of the portfolio. Okay. Or shares of the company. If you buy the company, okay, you buy a share of the company, you're exposed to the portfolio that the company owns, and they pass through the profits and losses of that portfolio to you as a shareholder. So that's the technical kind of way it's set up. But generally, Emma, you could say you have a small piece of a lot of different companies because you own a share of the overall mutual fund company. So share in a collection of professionally managed stocks and or bonds. Remember, mutual funds, are a company. They're companies that they collect our money, and you and me and Summer and everyone, we get together, we send our money to the company, and we are mutually funding now a pool of money that the company is going to hire a fund manager. They're going to take the money and they're going to go out and they're going to buy a bunch of stocks, a bunch of bonds, or a mix of stocks and bonds, according to the objective of the fund. And there's mutual funds for everything, folks, right? There's growth funds, there's growth and income funds, there's biotech funds, there's international stock funds. Usually what the fund holds within it is indicated in the name of the fund, right? But they provide ability to diversify at lower amounts. That's what somebody had said. They're a more affordable way to spread out your money than trying to do it yourself. Piece together a full portfolio of stocks. It would cost a lot of money. It would cost a lot of commission charges and so on and so forth. So mutual funds give us the ability to do this by just buying one share of the mutual fund company. You actually get exposure to all the investments in that portfolio. There are fees for this thing, right? They usually have an upfront, or they can have an upfront load, which is also known as a commission. The more highly managed funds are going to have higher loads, whereas more passive funds like index funds and ETFs will have lower loads, because that load is going to be partly just sales commission to the person who's managing it. And because index funds and ETFs are built to literally mimic a stock market index like the S&P 500 or the Dow Jones Industrial Average, et cetera, and just kind of mirror that index and not make very many changes, there's going to be lower loads and there's going to be lower fees. So the ongoing fees for mutual funds are called expense ratios. This is a percentage of the funds that are assessed before it even hits the end of the day, like what you buy it for. It's built into kind of the cost of running the fund, is the expense ratio, and the 12B1 fees, which also includes the distribution costs, marketing expenses, that sort of thing. And so the expense ratio has this 12B1 fee. And just be aware, loads or commissions. There are no load funds. A lot of times they're index funds because they're just, again, set to mimic an index and ride. Exchange traded funds are different from index funds and mutual funds, just because they can be bought and sold on an exchange rather than directly from the mutual fund company. So mutual funds aren't going to be trading on the New York Stock Exchange like single stocks, like the single stocks that they own inside their portfolios. That's not how they do it. You have to actually buy and sell the fund's shares directly from the company itself. Okay. Normally you can do this you could do this through an online brokerage account, online IRA or through your broker dealer or through your 401k. Like, you don't actually have to converse with the mutual fund company, although you can open an IRA or account with a mutual fund company and do it that way if you want. Okay. And when you do have a mutual fund, they don't trade during the day. They settle at the end of a business, at the end of the trading day, and the market's open from 9:30 to 4. And when the market closes, that's when the mutual fund figures out what everything inside of it is worth now at the end of the day. And it comes up with something called a net asset value. That's the cost of the share. And that's how they figure out day to day how much you made for the day or how much your balance went down. And somebody asked, with ETFs becoming more popular, is there an advantage to buying a mutual fund over an ETF? The biggest advantage with a mutual fund over an ETF, Tom, is that when you're thinking about mutual funds, a lot of times you're talking about professional management, which you'll pay a little bit more for. But some people like that because there are funds out there that they're actively managed by fund managers. There's not a lot, but there are funds out there that can beat indexes and have beaten the indexes that they're benchmarked against. Those managers, again, they're few and far between. Statistically, actively managed funds do not outperform indexes that they're benchmarked against. So most people are just fine going with like an index fund or an ETF. But there's advantages to maybe mixing it up and owning a little bit of both. Yeah, if you look at the numbers, Albert, you can see that over time, you're right. Yeah, index funds outperform actively managed funds. And it depends on what you read, but it can be anywhere between 80 to 90% of the time. There are those actively managed funds and companies that do outperform indexes. But again, you probably are going to have to do a lot of research and have somebody in your corner to help you pick one that can do that. What does REIT stand for? What does REIT stand for? Yeah, Tom, you got it. Real estate investment trust. What is a real estate investment trust? Do we know what a real estate investment? These are also becoming very popular. Yeah, I mean, Albert, I mean, you could put it that simply, right? It's like a mutual fund that holds mortgages or real estate property ownership. And it can be in different types of real estate, whether it be like medical facilities or apartment complexes. There's real estate investment trusts that own residential mortgages. And Michael, you're exactly right. It allows you to invest in real estate without having to actually own the brick and mortar house. So it's becoming very, very popular, real estate investment trusts. And real estate investment trusts, they're required by law to pass through the vast majority of their revenue to their shareholders. So it is like having a portfolio of rental properties, but not having to manage tenants. So that's, I think, part of why they're so popular now. Futures and commodities, okay, these are types of what are known as derivative securities. And they are very high risk because these are basically contracts that either give you the option to buy or sell something in the future or the obligation to buy or sell something in the future. And so they come with a great deal of complexity. Again, they're probably not something that you're going to be dealing with a lot in your just financial counseling. If somebody comes in and they're asking about derivatives or options, it's probably something you want to refer them to a planner, but a lot of planners don't even deal with derivatives and options just because they are so high risk. So they'd have to be kind of a planner who's comfortable doing that. Collectibles, these are going to be things like your jewelry, baseball cards, stuff like that. Unpredictable markets for sure require specialized knowledge of the industry and the market. And again, high risk, right? You can talk about anything from jewelry to, vintage autos, that sort of thing. So you have to have some specialized knowledge about that market. Precious metals, this is where everyone likes to flock to in times of crisis. Everyone likes to buy gold and silver. And I'm still not sure exactly why, because historically, if you just invest and stay invested, and then you'd be better off mathematically sticking in something like an index versus like gold over the last 40 years. That said, you can buy precious metals without owning the bullion, just like you can buy real estate without owning the brick and mortar. You can buy precious metals inside like a precious metal ETF or something. So I tell people, I've told people when I was an advisor, if you want to have precious metals as part of your portfolio, great, but you don't have to go out and actually buy the bullion, which is a lot less liquid than just owning it in an ETF. Yeah, so Robinhood's so this is, Robinhood, I think, gives people a play space, Summer. It gives people a sandbox to kind of get their feet wet with, stocks, with whatever it is, maybe some options and stuff like that. But I know that there's, you can really lose your shirt if you don't know how to do, if you don't know how to trade options correctly. So in Robinhood, obviously, has been another thing that's been in the news lately with regard to investing. But the precious metals, that's one of the things. And the other thing that's not on this list here for investment options is Bitcoin, right? Cryptocurrency, which again is high risk, not, it hasn't been around for a long time. People have made a lot of money from it. It's not as liquid, right? So guess what? There are now crypto ETFs. There are ways to have exposure to cryptocurrency without actually owning a digital wallet and having to figure out how to get the crypto and how to actually, profit off of it or cash out of it. Like, there are ways to benefit from crypto investing without actually having to own Bitcoin. You can own an ETF shares. And again, this isn't something, diversification is key, right? You think about, remember, asset allocation. Well, these are all asset classes that you see on the screen, right? Real estate is an asset class. Collectibles is an asset class. Precious metals, an asset class. Cryptocurrency, an asset class. So asset allocation means if you want to include these, you can put some of your money in these, right? But you also need to make sure that you're having proper exposure to stocks and bonds, which are a little bit more liquid, right, than a lot of the things that you see on the screen here. So having some of your money in some of these things, if it's something that you're willing to do the homework on and pursue and maintain and monitor, is, the prerogative of the person, but they'd want to get a lot of education before they dove into one of these areas. Okay. Yeah, I mean, investing in general, a lot of stuff. Say very short slide deck, but I feel like I raced through it just to try to get through everything. So we have a couple minutes here. What did I go by too fast that there might be more questions on that wasn't covered in good enough detail? And I'm happy to go back and revisit or just answer any general questions about investing you might have before we get to retirement planning next week. Any discussions on how to use margin to invest? Have I had any discussions? I've had discussions with people on how to do it, but we didn't talk about it tonight because it's a little bit outside the scope of the intro to invest. It's kind of like in the realm of derivatives, using leverage, but generally speaking, using margin I
would say I won't guarantee it's not on the test, but in general, AFCs don't talk about it. And don't forget the test is based on what AFCs say their job actually is in a job survey. So when thinking about what might be on the test, that's something to keep in mind. It's what AFCs actually do. They actually base the test on real feedback from AFCs.
That's great. And yeah, I don't know if a lot of AFCs are talking about margin accounts.
Well, I guess almost none.
Yeah. I mean, and in general, just for those who are like, what is a margin account? It's when you get to borrow money to invest or borrow stocks to sell from your broker. And so you're borrowing, you're going into debt to invest with the thought that you can buy back the stocks at a lower price to make the profit. And that's a margin account.
Those are sometimes called leverage investing too, when you
Yes.
borrow to invest.
And by the way, that's a lot of times, that's what hedge funds can do and stuff like that.
Retirement is next week, along with estate planning.
Yep, IRAs, 401ks is covered next week. And then somebody said, can you revisit the difference between mutual fund deposit accounts and money market mutual funds? Yeah, so they're both considered cash equivalents, but they're just different entities that are often confused because the word money market is in both of them. So think about money market deposit accounts are like just a fancy savings account, okay, at your bank or credit union that pays a little bit higher interest, but it's not a mutual fund. It's a money market deposit account, whereas a money market mutual fund is an actual mutual fund. And the goal of the manager of that fund is just to get the net asset value to equal $1 all the time. And that's what they do. And so you can own, if you have your cash in quote unquote cash at a brokerage firm in a brokerage account, they're going to park it in a money market mutual fund. So it's not sitting in there in cash like it is at your savings account at the bank. It's in a mutual fund, but it's totally liquid and they can get to that anytime and they keep the value of the NAV stable at $1. They're both considered cash equivalents though. And they're usually invested in short-term debt, like we talked about T-bills and something that corporations use called commercial paper, which is just bonds that mature in 90 days or less. Somebody asked, what are your thoughts on these new investment education companies such as IM Academy? I don't know a lot about them, Jacqueline. I haven't used them. I think investment education in general is sorely needed. So I think that if they're doing it for the right reasons and don't have a lot of ulterior motives, I think it's great. And that's part of the reason I love the free resources out there from FINRA and the SEC. I'll tell you what, folks, go to the SEC's investor.gov, go to FINRA's Investor Education Foundation, and they're going to have amazing resources for you to use in your counseling. That downloadable PDFs, calculators, etc. So you don't have to reinvent the wheel. So check them out and let me know what you think.
I'm posting a link to saveandinvest.org. That is FINRA's, and they are defunding it. So if you're interested, I check it out soon because I don't know how much longer it's going to be up.
Oh, that's sad.
Yeah.
Oh, but this isn't the this is their like literacy program, but I'm thinking of their actual investor education foundation. So it's something different for FINRA. Oh, Investor Education Foundation. Oh, is this their actual foundation site and they're defunding it?
Yeah.
Oh, that makes me sad.
It is sad. So.
Well, there's investor.gov. Investor.gov is a good one too. All right. I see one more question here. Looks like we're almost up to the clock.
Yeah, that one's a personal one. So I'm going to just stop the recording really quickly. So this is not on the recording.